All right, here we are. It's Wednesday morning, 10 a.m., a little after 10 a.m. It's 10:01. I was a little nervous because the transition from my streaming service to YouTube took a little longer than usual, and I thought, oh no, here we go again. Well, hopefully we have a webinar today, folks. We had I shared with you some delays due to some personal family matters, and then last week I was sitting here, started my webinar and went through maybe the first 15 minutes, and I've got a lot of buzzes on my cell phone and telling me that it wasn't really listenable or watchable because of some delays and then speed ups and things like that. So I spent a lot of time between last week and this week with our tech support group, and I sat here yesterday for about an hour with a YouTube live private video running while I was doing some work just to make sure that everything was working. So hopefully we're good. So good to see you. It's been a crazy ride over the past couple of weeks in the markets. We're going to talk about that a little bit. Our topic today, again, is should I have a mortgage in retirement? And this is a big topic because, a common goal for folks entering retirement is I don't want to have a mortgage. And, we have a lot of conversation around that, and we're going to talk about the pros and cons, and I'm going to show you the numbers of what an effect can be from a real life scenario. So we'll go over that. But let's first go into the some things that we have coming up. So next, in 2 weeks, 2 weeks from today, March 26th, we're going to be hosting a movie at the wonderful Newtown Theater called The Psychology of Retirement. And it's based on the best-selling book, The Psychology of Money by Morgan Housel. So it should be a really great event. Now, I would have loved, typically we like to send invitations out 3 weeks prior to an event, but the producers of this movie are very strict about what's allowed as far as timing of invitations, and they have to send the movie directly to the theater. It's kind of interesting. So we'll see how that works out. Good morning, Paul and Denise and Emily. Good morning. But it should be a lot of fun, and I think you'll find it beneficial. So if you like to join us, that's March 26th, and it starts at, I believe, 6:30. So just plan on 6 o'clock, 6:30, something like that. Where I shared with you that through our Rotary Club, we're also a sponsor of Hope on the Vine, which is a fundraiser. It's the largest fundraiser for the Newtown Rotary Club every year, and our Rotary Club really does some great things for the community and worldwide. Attleboro Wealth Management is the sole sponsor for the Newtown Theater Wine Walk on May 17th. We have a limited number of tickets for that for our clients only. So if you're a client and you want to attend, we have a limited number of tickets. I think we still have some tickets. Stephanie will let me know if in fact I need to stop saying that. But anyway, we're sponsoring that on May 17th, and that should be a nice time. You should definitely you would have gotten an invitation to that. We had a really successful and really fun class series that just ended at the end of February, and I shared with you, certainly last time, maybe you couldn't hear me, that we had over 150 people attend this class series. It was so popular that we had to add an extra 2 nights. So each series has their own 2 nights, 3 hours each class. So we had to add a series of Thursday evenings, and it was a really well received, and it just tells me that so many people out there need education around their retirement planning. We have an upcoming class starting on May 1st at Holy Family University, pretty much right across the street from us here at the office. And that begins Thursdays, May 1st and May 8th. That's your Thursday series. And Tuesdays, May 6th and May 13th. So many of you have asked to be notified about future classes. So here's your notification. If you're on our email distribution list, you'll receive an email. If you're not on our email distribution list and want to be, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. Ask to be put on the email list, and we'll do that for you. Alternatively, you can go to our website, go to just about any one of the pages, but certainly the webinar page, and you can request to be on our email list there. There's no lack of opportunities to join an email list on our website. We're also working on an advanced class series. I'm hoping to start that in mid-April, but as mid-April is getting closer, that may be delayed a little bit. There will be no webinar next week. I'll be away for the week, so our next webinar will be on March 26th. Okay, so we've got some headlines today. So the Consumer Price Index number came out today, this morning, and it was lower than expected, so that's good. So 0.2% month over month, as compared to, or expected was 0.3, so lower than expected. So the BLS, Bureau of Labor Statistics report reads, the Consumer Price Index for all urban consumers increased 0.2% on a seasonally adjusted basis in February after rising 0.5% in January. The Bureau of Labor Statistics reported today, over the last 12 months, the all items index increased 2.8% before seasonal adjustment. Shelter rose 0.3%, accounting for nearly half of the monthly all items increase. Let's see what else is meaningful in there. The food index for food, 0.2% was the increase for food, and then looks like home costs increased 0.4% as well. Interesting feedback and information from the BLS regarding the Consumer Price Index. So that's the measure of inflation. So when you hear me say Consumer Price Index, that's the typical measure of inflation that we use. So if I'm looking at the markets today, well, before I sat down, part of the market was up, but part of it is down today, and we're going to talk about it. Talk about that more as we move forward. So let's move into our slot reports here. So I'm going to share my screen. In our first section, I thought was interesting. So this came out 2 days ago, written by our friend Sarah Brenner, who you've all met. And the title is How Roth IRA Distributions Are Taxed. So Sarah writes, do you have a Roth IRA? If you do, there will very likely come a time when you want to take a distribution from that account. The distribution rules for taxation of Roth IRA distributions can be complicated, but if they are followed, the reward is tax-free withdrawals in retirement. Here is what you need to know. The first is aggregation. Things can get a little confusing if you have more than one Roth IRA. When determining the taxation of a Roth IRA distribution, all of your Roth IRAs are aggregated. What does aggregated mean? Well, simply put, this means your Roth IRAs are considered one account for tax purposes. Your IRA custodian reports the distribution on Form 1099-R to you and to the IRS. You will be responsible for determining the taxation of your distribution. You will use Form 8606 to report the Roth IRA distribution on your federal tax return. Tax year contributions. Amounts up to the total of your Roth IRA contributions are considered to be distributed first. These amounts are not taxable or subject to the early distribution penalty, even if you take them out before 5 years or before age 59 and a half. So these are contributions. In other words, you always have access to amounts equal to your contributions, tax and penalty free. Maybe, for example, you contributed to your Roth IRA in 2018 and you're now 32 years old and need that money. You will not be taxed or subject to penalty when the amount of that contribution is distributed. It doesn't matter that you are not yet age 59 and a half. It doesn't matter how you use the money. Again, that's for contributions. There are specific rules that follow the money that goes into the Roth IRAs. Now let's talk about converted amounts. So there are two ways to get money into Roth IRAs: contributions and conversions. A conversion is an allowance of a distribution from a traditional IRA and a redeposit into a Roth IRA. The cost of that, of course, is taxed, but that's really what a conversion is. It allows you to take money from a traditional IRA, redeposit it into a Roth IRA. So let's talk about the converted amounts. Amounts up to the total of your Roth conversions are considered to be distributed next on a first in, first out basis. So she's talking about contributions first, conversions next. These are what are called ordering rules. First contributions, next conversions. So these are distributed next on a first in, first out basis. If you converted both pre and after tax amounts, the amount of your pre-tax amounts is distributed first. Distributions of amounts equal to your conversions are not taxable. Remember, you already paid tax on those funds when you did the conversion. Pre-tax amounts are subject to the 10% early distribution penalty if you're under 59.5 at the time of the distribution and the conversion was less than 5 years ago. There are exceptions to this penalty, such as disability or death. If you are over age 59.5, you can immediately access the amount of your converted funds without worrying about the penalty. There is no 5-year waiting period for you. Now, how about earnings? The earnings is the last in this series of ordering rules. The remaining portion of your Roth IRAs are considered earnings and are the last thing distributed from your account. Those amounts are tax-free and penalty-free if the distribution is a qualified distribution. A qualified distribution is made after you have had any Roth IRA account for 5 years and you are over age 59.5. You are disabled, you are taking the funds for a first-time home purchase, or the distribution is to your beneficiary after your death. If your distribution of amounts equal to earnings is not a qualified distribution, it will be taxable and subject to the 10% early distribution penalty unless an exception applies. Now, listen, this is the reason, if you think about it logically, the reason that this 5-year rule and these ordering rules really came about is when Roths first appeared and these conversion strategies first appeared, there's always somebody looking at a way to game the system. So people were taking their traditional IRAs, converting them to a Roth IRA, and then making their distributions, taking money out of the Roth IRA and avoiding the 10% penalty. So prior to age 59.5. So that was closed up with these rules around distributions for conversions. Tax-free distributions in retirement. You are not required to take any distributions from your Roth IRA during your lifetime. Unlike traditional IRAs, Roth IRAs are not subject to the lifetime required minimum distribution rules. However, if you do decide to withdraw funds, a qualified distribution will be completely tax-free and not included in adjusted gross income. By taking a qualified Roth IRA distribution, you can therefore avoid the stealth taxes that hit many retirees hard, such as taxation of Social Security benefits or Medicare surcharges when income rises in retirement. And that is a big part of our planning, of course. When we're moving folks from traditional IRAs to Roth IRAs, if that makes sense to you, there are qualified Roth IRA distributions don't count towards provisional income, which is the income that's tracked to determine how much of your Social Security is subject to tax. It also doesn't trigger these things like IRMA charges, the income-related monthly adjustment amounts, and that's the extra surcharge on your Medicare, and of course, overall tax. Everything is all qualified distributions from Roth IRAs are tax-free. So it really makes sense to look to see if that type of tax-efficient strategy works for you. So here's the mailbag, and this is by our friend Andy. The first question is, hello, if a person is turning 73 years old in March, he or she would be required to take required minimum distributions for the year. Can a person do a Roth conversion prior to turning age 73, say in February? Does this first money out rule still apply? And this person is Ravi. So Ravi's asking, is there a way that we can circumvent RMDs by doing a Roth conversion? So the answer is, if you reach age 73 in 2025, then you have a required minimum distribution for 2025, and the first money out of your IRA this year will be considered your RMD. If you convert prior to your 73rd birthday in March, you will still need to take your 2025 RMD prior to the conversion. So that's a big mistake a lot of people make. You must do the conversion, and now the rules say you must do all conversions prior to Roth conversions. So don't make that mistake of doing a Roth conversion before your RMD, because you're going to have to make a correction. Is it possible to reverse part of the Roth conversion that I did from my traditional IRA? The answer is no. It is not possible to undo a conversion. In the past, an unwanted conversion from a traditional IRA to a Roth could be recharacterized back to a traditional IRA. However, the Tax Cuts and Jobs Act eliminated recharacterization of Roth IRA conversions back in 2018. If I could have two wishes for the tax code, simply, it would be please allow us to do Roth conversions up to the tax filing deadline like we can contributions, so April 15th usually of the following year, and allow for recharacterizations of Roth IRAs. But that's not the case, right? So they're not the rules as they are today. And I don't think recharacterizations are coming back because Congress loves Roth conversions because they're getting their tax money now and they don't want to give it back. So that's our slot reports. Now let's talk about investments. I want to first talk about the returns of the market last week. So the Dow Jones Industrial Average was just about flat, 0.91%. It was up for the week. The S&P 500 last week was down 1.67. The NASDAQ was down a whopping 5.66%. Now, I'm going to share my screen here. So I'm actually just going to block out who gives us this report. But I want you to look here. This is what I'm referring to right here. So the Dow Jones Industrial Average, the S&P 500, the NASDAQ, the MSCI World Index. So the international stocks are all, companies are all positive, or stock indices, not companies all, but the indices are mostly all positive so far this year. We have some areas that are slightly negative, but in comparison to the U.S. markets up here are all negative year to date. So that is a really, really good argument for basic asset allocation. So basic asset allocation tells us, and strategic asset allocation, specifically tells us that we want that balance in the markets. Now, international markets have been underperforming for some time. If you were, kind of the Money Magazine, you might remember Money Magazine kind of investor. There are a lot of people that would look at ratings in a magazine when we still had magazines, or even online today, and say, okay, these mutual funds were the top mutual funds last year, so I'm going to put my money into there. Now, if you did that last year, certainly the U.S. markets were very, very strong last year, and then you would be suffering some downturn already this year. And maybe you would avoid the international markets here, but you'll see that part is giving us a nice return so far this year. So that's why you want that balance, and that is asset allocation. So I often talk about the three pillars of investment management. We have asset allocation, principal protection, and account segmentation. But that is just a very, very good example of why you want proper asset allocation. Now let's look at the fixed income section here. So this is the bond market. So you'll see that where most people have their money is the U.S. aggregate bond market. So that's typically a 7 to 9 year maturity, what we call, and that means that's when those bonds mature. It doesn't mean that you're going to hold them for that period of time. We're referring to more active management. So really, bonds are being traded all the time. But so far, I'm sorry, I had this backwards. When I was talking about year to date and 1 year. So let me back up here. Well, I don't see my pencil here, but my apologies. So these were 1 week numbers, and these were year to date numbers. See what a few weeks of not broadcasting does to you. You forget how to read the graph or the chart. But still, we're in a very negative market. So year to date, the NASDAQ is down 5.66%. The S&P 500 is down 1.67%. And just last week, both of these indices, I know this is getting messy, were down 3%. So now let's look at the bond market. The bond markets were down. This index was down 0.58% last week, still positive for the year. And then again, we're seeing positive bond returns for the year so far. This is down here, alternative investments. You'll see, one that's being watched very, very closely so far this year is Bitcoin, and that's a relatively new ad. That's down about 6.5% year to date. Last week, positive 3.8%. Now, I'm not showing you these market returns to suggest that you focus in any one category. This is solely for education, just so you know what's going on. And the Fed funds target rate has stayed the same except with the exception of 1 year ago where we were at 5.5%. Okay. So there were the returns of the market last week and year to date. So what does our analyst say? And we talked about CPI already, but we know that last week, looking at last week's reports that came in, ISM Manufacturing. So that's the survey of sentiment in the manufacturing sector, and that fell 0.6% to 50.3. So what that means is that's showing the impact of these new or these tariff fears, and see where that's going to go and what additional costs are that's going to bring to the consumer. I'm not sure how that's going to work out, but I'm looking at, I have CNBC on the TV right next to me, and that's the headline almost every time I look over, is talking about tariffs and how that's going to affect things, because that's potentially inflationary. So we get very excited about CPI being below expectations, but then if we've got increased inflation and potential recession on the horizon, then I think we're certainly looking at that. Then we've got to pay attention to those things. ISM services. So manufacturing was the first report. Services. This survey is sentiment in the service sector, and that rose 0.7% to 53.5. The survey respondents mentioned uncertainty with government funding and, again, tariffs, but most remained cautiously optimistic. The service sector continues to expand, but that may be threatened should the tariffs and the reciprocal actions continue for the foreseeable future, our analyst writes. We had the labor report. The U.S. economy added 151,000 jobs in February, slightly less than expected, but up from January. The unemployment rate rose to 4.1% from 4% flat, so up 0.1%. So we talked about CPI already. We received this morning. That was below expectations. And then tomorrow we have PPI, which is wholesale inflation. And we'll see where that ends up. Okay. So I want to share with you some other analyst reports. So the first is Goldman Sachs. Excuse me. Goldman Sachs had a good report about geopolitics. So I'm just going to read an excerpt from that. So the geopolitical backdrop has become increasingly complex, they write, with the global economic policy uncertainty index reaching an all-time high. Tariffs, fiscal stimulus, and policy responses to geopolitical tensions or conflicts are top concerns for many investors as they navigate market volatility. So Goldman Sachs, again, writes, while we think the fundamental backdrop is resilient, we expect more volatility ahead. With that said, we believe investors may benefit more from staying invested as attempts to time the market may miss short-term recovery and long-term growth. And I agree with that wholeheartedly. People ask me, how do you react? We were just talking to a new client the other day, and actually we had two people almost back to back to say, crazy things are going on right now. The markets, there's a lot of turmoil. There's questions about increased prices, and this is a big year for tax change. That's certainly a lot of uncertainty. How do you react to these markets? And the answer is we usually don't. There have been times when we made some tactical moves. In 2022, you've heard me say we sold out of our bond funds early in the year. That turned out to be a very, very good thing for our clients. We saved our clients millions of dollars. We held cash throughout the year as the bond markets fell, and then we started going back into short-term holdings like money markets and 90-day bonds, and then reallocated beginning in 2023. So there are times when we'll do things like that, but for the most part, I say I'm expecting a 40% drop in the market at any given time. So I go back to the fundamentals of account segmentation, asset allocation, principal protection, and account segmentation. Because, we're talking about Goldman Sachs and they're saying stay invested. But what areas do you stay invested in? That's where your financial plan and account segmentation drives that decision. You want to have exposure to international markets, U.S. markets, all the bond markets, all the different areas that grow over time. The question is, how best to do that. So, if you don't know what I'm talking about when I talk about asset allocation, principal protection, and account segmentation, then you should go back and look at the 3 pillars of investment management video. We'll drop that in to the description in this video. But that gives a good overview of really how this system works. But it is a plan-based investment system. So we make sure that you have conservative holdings for the time that you're going to need to draw funds, but we make sure that you've got growth holdings for longer out in the years. Really starting 6, 7, 8 years out, we start really putting stocks back into the equation. Even 4 years out, we implement. We have some stock holdings back in our portfolios, but with some level of protection and buffers. But because even the best out there, we're talking about Goldman Sachs. I'm going to read to you BlackRock for a second. They're making educated guesses really about where the market's heading. So BlackRock writes, big policy shifts reinforce higher rates. Higher for longer, they say. U.S. tariffs in Europe boosting fiscal stimulus reinforces our view of policy rates staying higher versus pre-pandemic levels. Here they have an underweight. They say we go underweight European bonds. Market backdrop, they write the U.S. stocks. This is just a look at what happened last week locally and globally. U.S. stocks slid 3% last week on market concerns about policy uncertainty. German bond yields jumped the most since 1990 on big fiscal spending plans. That's interesting. And they were talking about the CPI, of course. They said, we think solid if slowing job growth and persistent wage pressures should show sticky core inflation in next week's February U.S. CPI data. So as you know, CPI came in lower than expected. So we'll see what their BlackRock's input is from that. Now, speaking of BlackRock, I wanted to share with you, they came out with their capital market assumptions. So capital market assumptions, these are updated capital market assumptions. So the capital market assumption is really where you think that you're going to see, like how you think the market's going to perform in different areas, what the growth rate's going to be. It's a little more complicated than that, but, there's, it's really, or it's based on this capital market assumption line. I can't draw on here. And where we expect to see returns given certain amounts of risk. So let me shift here. I'm going to change my location. Yeah, okay. So I want to share this with you. My purpose of this is these are strategic allocations that BlackRock is showing represent different type of investing throughout the world. And I share this with you because there's a lot of questions about, okay, where should I have my money? Should it be overweight here? What should my asset allocation look like? And my purpose in showing you this is that there are different reasons for each one of these allocations. So some of it is simply, this is where these managers think the market is going. And if you're just listening on the podcast, this might be a good thing for you to check out on YouTube. Because you're going to see some drastic changes in these allocations. So go to the YouTube video, and if you don't have time to watch the whole video, at least watch this section. But when we're talking about strategic allocation, this really isn't market timing, right? This isn't. We think that, for example, if someone's saying we think that gold is going to overperform for the next X number of months. So we're going to overweight gold for a period of time. These are longer term projections, but it's still, you're going to see how there's different allocations here. So what I have in front of you first is an overview generally of U.S. corporate pension allocations. So what we're looking at here is the big yellow section are bonds and liability hedging. So what does liability hedging mean? We're talking about investing in credit and interest rates. But if we go back, we've got very little, asset to equities, which are stock, 9.6% here, 2.6% here, and then 12.1% here. So developed equity, emerging, and then general equity. So we've got 12% general, and then it's broken down 9.6% in large developed economies, and then 2.6% in smaller, more developing economies. But overall, just a 12% allocation. So this is not guidance. I am not saying to you, this is how you should be invested. I'm giving you an example of how generally corporate pensions are across the country. So then we have private markets. So this is an asset class that we invest in too, and we're starting to see some expansion across investments. But we'll see here 13% in private markets, so 12% in publicly traded stock, 13% in private markets. You break that down in growth and income, so that would be private debt. And then again, you've got almost 75% in bonds and liability hedging. So now if we drop down here and let's look at a family office. So a family office is much different. So they're managing very wealthy families. You're talking about hundreds of millions of dollars somebody typically has when they're working with family offices. And generally, this is how they're investing. They've got a much larger allocation of private markets, 40% allocation. Normal publicly traded stock is 35%, and bonds are 24%. So you'll see a big difference there, and that's about the objective, again, how the investment managers think that these markets are going to perform and the needs of their clients. Now let's go down here to the UK. If we look at UK institutional multi-asset, we see much smaller private markets and much heavier in alternatives like hedge funds and whatnot. So 19% in hedge funds, and we have 34% in publicly traded stock, 36, call it 40% in bonds. And then let's just take one more look at general European wealth manager, and you'll see that is also completely different. So again, this is not recommendations, or these are not recommendations. Why am I sharing this with you? Is because these are some of the best in the world, folks that are managing portfolios this way. And depending on the objectives of the different managers, they have completely different focuses and holding percentages and allocations. So what do you do when you hear, because you'll hear people say, well, I do this, or my financial advisor does that. And, somebody was talking about a timing strategy that their financial advisor does. Well, most timing strategies, in my experience, this is only my experience, they don't seem to work very well. They might time very well or get lucky occasionally, but in the long run, doesn't seem to work very, very well. So I go back to the basis of build your foundation, the account segmentation, principal protection, asset allocation. It's all vitally important. What is the correct allocation for you? Is it the European wealth manager? Is it the U.S. pension? Because you could say, hey, U.S. pensions invest this way. Why don't I just track that? It's all very, very individualized. And when you get down to, general asset allocation is something that's very, very broad. It's really what your pie chart looks like, and then how do you manage the components to be the best that they can be within that pie chart, and then what's your method for keeping it in line, keeping it in rebalance. So that's kind of the simplest part of it. When you get into principal protection, and certainly when you get into account segmentation now takes that asset allocation and plots it out on your lifetime chart at all different levels and all different pie charts. Those pie charts you just saw that different managers, top tier managers, are using around the world may be part of what you're doing, but they rely on that account segmentation timeline for the different times that you need it. There's a reason that pension managers, the U.S. corporate pension managers, for example, I'll just bring this back. While they may have 75% of their money in bonds, it's because they have to pay all these pensioners and they might have on average, there might be more pensioners than future pensioners. So they need more immediate income and return on that money than they do hedging future growth. So that may be the reason for that. I don't know. And it might be that, when we look at, I think the most stark difference here was family office, maybe not institutional okay, they're pretty similar, but we might have more stock exposure here because those specific clients need more growth. Anyway, the idea is don't follow just one path, whatever that path might be or might sound the most exciting at the time. Plot your investment returns and your investment strategies strategically for the time that you're going to need it. Have it make sense for you, and that should be driven by your financial plan. And I'm talking about that a little bit more today because the markets there's a lot of volatility today, and we're getting the question a lot. What do you do when you see a big market rout happening? And again, I think the markets could drop 30 to 40% at any given time. And we build our strategies based on that idea. Not that we want to be overly conservative, but we want to be protective where we need to be protective. And for our folks, that means the money they're going to spend in the meantime, in the near term. All right, I hope that's helpful. All right, we're going to jump into now our financial planning topic. So let me share my screen. All right, so we're going to talk about, this is the financial focus part of our webinar. If you are you just joining us for this topic and you haven't already, please hit the subscribe and like and notification buttons on the YouTube channel. We always like that. But this is the second part of our weekly webinar, and we call it the financial focus. And this is where we talk about a financial planning technique. And today comes from a client discussion, like almost all of these do. And it's, should you have a mortgage in retirement? It's a common goal for retirees. A common goal for retirees is, hey, I don't want to have a mortgage. And if you have the house you've been living in for the last 25, 30 years, that could make a lot of sense. Why not pay it off when you're ready to retire or soon in retirement? A lot of these discussions today that I see have to do with second homes and downsizing. So that's where, and in this example, this person said, well, I want to downsize. And in fact, they had downsized or sold their home and they wanted to replace that home. So in the very beginning, when we started talking to them, they were renting. And they said, okay, well, we want to buy a home. So we had this discussion. Does it make sense to have a mortgage on the house or to buy it outright? So we're going to talk about the math behind that and some possibilities of what you could do with funds that you're using or not using for that mortgage. But then we're also going to talk about, the thoughts and feelings behind that, because a lot of folks are, they have these built-in beliefs that they've learned over decades. We talk about many of them when we talk about tax efficient planning. You're told, taxes are going to be lower in retirement. You're going to spend less money in retirement. And anybody who has followed me for any period of time knows that my experience is that's just not true. Most people are going to be in a much higher tax situation in their retirement, and they're probably going to spend more, certainly in their early years of retirement. So these are things that you have to plan for efficiently, and we'll talk about that. But this is a very common discussion. And in this case, the question is, do I take $650,000 out of my investments and buy this house, or do I take 20% out of my investments and float a mortgage for the remaining amount? And you might be surprised at the outcome. So what I'm going to do is I'm just going to work through with you our financial planning tool, and I'm going to show you the different outcomes. So let's first look at, I'm going to pull this down. So this is a tool we use. We call it Plan Tracker, Attleboro Wealth Management Plan Tracker. You'll see this e-money, but to make things less confusing for our clients, we call our planning center Attleboro Wealth Management Plan Tracker. And for investment performance, we use Attleboro Wealth Management Investment Tracker. So let's first look at this. Now, let me explain how the planning works. So we've got this base facts. So base facts is everything as when someone comes to us as it is today without changes. So in this person's case, they were heavily weighted towards in their retirement accounts, and also had some what we call taxable investments, non-retirement accounts. And they were paying rent, and we had a very good measure of their expenses because of the process we go through to identify expenses. But we show a couple things here. So follow me over, and we refer to those as base facts. So that's their base facts. Everything before, like they never met us. So you'll see here that they start with about $1.7 million, and what's projected is over their lifetime, they draw that down. That's normal. That's normal to see that. And if we project out to age 95, they have about $301,000 left. I hope you can see that. I can make that a little larger. Now, this is important here. This is unfortunately where a lot of financial planning stops. And I hear this from people because I'll have somebody come and attend a class or find us on YouTube or in some other method, and I'll do an initial projection and I'll say something to them like, well, I'm concerned about this area here because it looks like you may have the risk of running out of money at age 80, age 85, something like that. And they'll say, I've been asking my financial advisor about that, and they say, oh, everything's going to be fine. Don't worry about it. You're all set. Well, the reason for that is that a lot of people just look at these linear projections. So that's assuming you're going to get a static rate of return. You know, there are two ways that we have rates of return on different accounts assigned in the investment portfolios. And number one is we pull it from the information. So however it's invested, we get the historic rate of return, and we can do some projections that way. The other way is we assign a rate of return based on the holdings or what the anticipating holdings are going to be. And then it's just an assumed rate of return with an assumed inflation amount and liquidation strategy along the way. And this is where you get, well, hey, my financial advisor says everything's going to be okay. Well, if you just drop in, so you're going to see these what if scenarios here. So if you just drop in something like, what if you have a bear market, right? So we duplicate the Great Recession. Well, that's a big difference there, isn't it? Holy cow. That's a drop of $1.8 million. The assets only last until age 82. And that's where we'll start seeing eyes open. Like, yeah, we can have a bear market at any time. Are we in a bear market now? The beginning of a bear market now? I don't know. Like I said previously, when we were going over investment returns, here we are, March 12th, 2025. We were going over some analyst reports and investment returns. And I said, I expect the market to drop 30 to 40% at any time. That's how we build our investment models. We're not overly conservative, but we have a method, asset allocation, principal protection, and account segmentation that helps mitigate the risk of these and pain of these significant drops when you need it. And then if you lay over higher taxes, that shows a similar drop. And heaven forbid, if you lay over a bear market and higher taxes, it just gets worse. So that's kind of step number one. So let's go back to base facts. But in this case, the first thing you want to do, even with base facts, and my advisor says everything's going to be great. And this fellow in particular said that all the time. He said, this guy says everything's going to be good. If we just look at what we call Monte Carlo simulation or probability of success. So this looks at all different returns, not just assuming static returns, but 1,000 different outcomes on your portfolio against your needs and withdrawals and whatnot. And you'll see instead of just, a smooth line and then coming down, we see different levels. Sometimes the markets are down, sometimes they're up, and they jump around. So we scroll down here and we look at probability of success, and we're at 53%. Now that's without putting any of these what ifs in here. That's not with higher taxes, and that's not with a bear market, even one bear market. We're looking at some drawdown here, but if we really want to pressure it and say, what if it's like the Great Recession, it would certainly make a difference. But this is already a failed plan. So now just because of time and experience, I can look back when I do this and I know, even looking at linear projections, that this is going to be a failed plan. But that's proven by saying, okay, let's look at this probability of success, and we're at an average market. That's what we want. I haven't done this, but let's look at an above average market. That's not what you want to base your assumptions on. But again, well, that would be great if we have an above average market return for the rest of their life. Is that probable? Probably not. Is it possible? Sure, but that's not what we want to. That's not what we want to count on. Now, if we go below average market, I don't think that's likely the case either, but they're in much worse shape. So we want to protect that. But let's stay with 50%. So this is the first thing, using more sophisticated math rather than just linear projections. We see 53% probability of success. That's a coin flip. You don't want that. You want at least 82%. 82% and above, there's a confidence that you're going to meet or exceed your goals. So we're going to stay here with this probability of success, and we're going to overlay some of these different scenarios. So let's go with scenario one. What if we buy the house outright, right? So base facts, we don't change anything else other than we're taking $650,000 from the portfolio. Actually, let's start with linear. Let's make it even look better. Let's start with linear because this is how the majority of financial planners would look at this to begin with. And you're going to see if we take the $650,000 out, well, you lose $536,709. Your funding lasts till age 95, and you lose 1 year of funding, again, linear projections, and you've lost $536,000. So you might say to yourself, okay, that's actually not bad. That's not as bad as I thought it was. And then you might be glib about it and say, I'm not going to live to be 94 anyway. But you better hope you don't, because you're completely out of money in this situation. But you might say, okay, I withdrew $650,000 to buy this house, and now I've got $536,000 left. But that's, again, not the end of the story. So let's compare that to, okay, what if we put 20% down? And again, this is linear projections, and this is running it for you. Well, now the value lost is $481,000. So you're to the good of about $55,659. So if you do 20% down, you're going to lose less. It's still not good, right? We're still running out of money. It's still a failed plan, so it's not something that I would recommend. But you might be sold on that if you're a little less concerned about having money left at the end of your lifetime if you're just using these projections. So now let's switch that. So we've got about a $55,000 difference between the two. Now let's switch that to not from linear to what we should be using, and that are the probability of success or Monte Carlo simulations. So here we have our $650,000 is drawn out, no mortgage. Now that 52% probability of success drops down to 49%. So that's the wrong way to go. You lose $7,020. So because you have some increases, there are some years where the returns were greater than the linear assumption. Some years there were less, but in this example, you have less portfolio loss, right? $7,020 compared to $536,000. Now let's look at a 20% down. And this is running the 1,000 different outcome. Now you're negative 83,000. So it's interesting, right? How it flips using real world examples. And probability of success isn't a crystal ball, but it's the best math that we have for our financial planning projections. But still, it's a failed plan. So both of these options fail. When the conversation we would have with the client is, well, maybe $650,000 isn't your number. Maybe you should be looking at something that's $500,000, or maybe, I agree with the idea of not renting forever if you can avoid it, because rents continue to go up, where even if you have a mortgage payment, the mortgage payment is going to be the same unless you refinance, hopefully to a lower rate. I don't know why you'd refinance to a higher rate, but the mortgage rate should stay static. Your inflation is going to come from the cost of maintaining the house, which you probably would have depending on your rental agreement. And of course, the taxes, which you would carry anyway in your rent. So I do like the idea of owning a house better than renting a house generally, if you're going to be there for a longer period of time. If it's only going to be for a few years, I think it makes sense to look at renting. Or if you're checking out other areas, I've often recommended to people who are looking to move to Florida, Arizona, another part of the country that's completely different to them and they haven't spent a lot of time. You might want to rent there for a little while before you buy something, just to make sure it's a place you want to be. I'm not talking about investment properties. I'm talking about a second home for you, or a new home for you instead of. So this doesn't stop here. There are many other things that we can do with this, but there's a couple things that I want to share with you. What really stopped the progression for this person was we weren't able to do the work we really wanted to do or needed to do for them with their financial plan, because we're looking at base facts here: 20% down, $650,000 down. Let's look at if we can do the advanced planning that we do with our team when we're talking about tax efficient planning. Again, principal protection, asset allocation, account segmentation. If we roll it over or into this plan, tax efficiency, proper asset allocation, principal protection, and account segmentation, let's see what we can do with that. So let's go to item number 3. So now we have Roth conversions, principal protection. There's an IUL, so Index Universal Life is in here as well. That's not for everybody, but in this example, it's part of the plan. And if we look at the same lifetime portfolio value, now remember the last one, they lost in that example. They were down. I'm sorry, I'm looking at my notes here. It was $83,000. I'm sorry, a $7,000 loss in total portfolio assets. Here, even if they pay upfront for their home, and we're still able to take advantage of the strategies that we have, we're positive $2.8 million. So this is not linear projections. This is using probability of success, Monte Carlo simulations, so you can see all the different returns. Now, this is a successful plan, 100% probability of success. Now, again, I haven't done it, but let's do if they happen to hit below market returns, let's run that. Well, that's still going to be successful 100% of the time. So this is where you build that stability. What if we have these big market swings? What if we have higher taxes? What if we have these things? So this is how you build that foundation. This is what I'm talking about. And we weren't able to do that for these folks because of these feelings about, this home purchase. Now that is putting the $650,000 down. Now, what if we did 20% down? So remember, the prior at paying out of pocket $650,000 was $2.8 million. Well, if we finance this, it's $5 million difference. So that is a $2.1 million difference to the good for these folks by having a mortgage instead of paying out of pocket, and being able to take the do the advanced planning steps that we would normally recommend if it makes sense for you folks. So the reason I share this with you is because it's, you hear different things when you're talking to people about buying a home. So, we're talking about somebody who's in their 60s, maybe 65 years old, and they'll say, I can't believe that you would recommend that we carry a 30-year mortgage at our age. That takes me all the way to 95. Well, who cares, right? Who cares if that mortgage is frankly never paid off? If you pass with that mortgage in, it's the cost of living in that property. The cost of ownership is one thing. If your goal is to own that property, you want to pass it to your kids or something like that, that's a completely different discussion. But the cost of living in that property may be less if you finance it as opposed to just paying outright. And you see the difference. It was, $2.1 million difference potentially over their lifetime if you're able to use those advanced planning strategies. And it was still a difference not using those advanced planning strategies. But still, the first version had a failed plan. So sometimes you have to, it's hard sometimes to set these feelings aside because we've been programmed for many years not to have this debt, not to carry that. And debt generally is not something I agree with, but sometimes it makes sense. And you have to look at the numbers and see what the difference is. Now, some people, and you might be saying this, and this was my experience with this individual. He said, well, the property is going to grow to $1 million probably by the time I'm no longer here. So my kids will have that. So you got to add that back in. So let's do that. Let's add that back in. Now the difference is $1.1 million potentially in your investment assets. So that closes the gap. But the difference is that you can't eat your house. I can't break off a piece of siding and have it for dinner. Now, I know that's sarcastic, but I can spend that extra $1 million for whatever I want. If your goal is to pass it to your heirs, maybe that's paying outright is the right thing. It wasn't proven out in this situation, in my opinion, as this person's fiduciary financial planner, and my job is to give the best advice that was the best thing for them. You might say, well, I could get a reverse mortgage. At some point, I could get a reverse mortgage, and then we could take money out of the house, and I can eat that money, right? I can buy food with that money. And that's true. You could certainly do that. And that's a plan that many people put in place for tax-free income, for long-term care planning. And it's not a bad thing. It really isn't. It's becoming much, much more popular. And I think that's probably something these folks would want to have in place anyway. If they paid for the money outright or paid for the house outright. But they could have, one thing they could have considered is doing a reverse mortgage to help buy the property. That's a whole other thing that should be explored in financial planning, if that's a potential for them. So the comments, another one was, well, I can just sell the property. If in fact I'm running out of money at age 85, like you say I might, well, couldn't I just sell the home then, and then I'll realize the cash on that, and I can then spend that for my needs. Well, sure you can. But geez, that seems like an unnecessary step and an unnecessary risk when you're at the point when you're potentially running out of money. You've got to be several years ahead of that, and then you're dealing with the swings of the real estate market. We've been very, very lucky for a long time that the real estate market has been as strong as it has been. But there are times then that is not the case, and sometimes it can go on for a long period of time. So will you have the time to be able to sell that property for what you think it's worth or what you need at age 85? When you're staring at hopefully you don't wait to the time when you're out of money, but you're staring at the door of running out of money, or heaven forbid, you suddenly need care. And those things typically happen suddenly. So again, best to compare. And the other one, it's going to cost so much more. Well, that is, the cost of that house might be more over the long run if you use a mortgage, but you see the benefit. I showed you the benefit potentially of doing it a different way. Now, again, this is not a recommendation for you. I am not saying this is definitely what you should do if you're considering a mortgage, or considering buying a home during your retirement years. I'm not saying do a 20% down mortgage. I'm saying evaluate all of the options and keep an open mind. And it might be that if you see, well, if I do this a little differently, if instead of taking $650,000 out of my investments and just buying this house outright, I do 20% down and then finance the rest of it. That will allow me to take these other steps to have a tax efficient portfolio, to be able to manage my investments differently, so that potentially in the long run, you've got a couple $1,000,000 more that you can spend during your lifetime, or if you want to pass to the next generation. So just keep an open mind about it. Try not to get caught in what your cousin, brother, sister, plumber says about financing things or investments or anything in your during your retirement, or even if you're far away from retirement, because there are always other ways to look at it. And unfortunately, as I shared with you, most financial advisors are only looking at that first snapshot I showed you, where they do those linear projections. Oh, you're going to be fine. Yeah, do it this way. Why would you ever take a 30-year mortgage at this age? Well, if you spend the time, the 25 minutes that we've spent going through this, and see the potential difference, it might change your mind. So my point is, I think it's worth the conversation, but it is an individualized decision. Don't take what I shared with you as advice. Take it as education. And the next time that you have a major decision like this to make, talk to a qualified financial planner about it. Talk to somebody who understands all these other scenarios, and don't be afraid to talk to somebody who does it a little differently, because doing things differently is often the difference maker in what you can achieve during your retirement. Folks, I hope this was helpful. It was so good to see you all again. I'm glad this was a successful webinar, and I'll see you in a couple of weeks. Take care. Bye-bye.